In this video, I'm going to walk you through the income statement, and we're going to look at a few income statements of public companies. Although you've covered all of this information before in other classes, and as you can see here, these are the notes that we had from our very first class meeting this semester, we're going to review this information for several reasons. One, some of the information, such as earnings per share data, you may not have discussed since you took intermediate accounting. Two, it's a good way for us to get familiar and more comfortable with using the income statements of public companies if you haven't already. Three, we're going to extend our analysis over the next few weeks. And four, you need to know how to build the income statement on the FAR section of the CPA exam. There are two acceptable formats of the income statement: the single-step and the multi-step formats of the income statement. Not many companies use the single-step, so I've just given you a sample here from whatever came up under Google Images. Here is Accounting Coach showing all of the revenues grouped together with total revenues and all of the expenses grouped together. You'll see that there's just one formula on the single step, which is simply revenues minus expenses gives you your net income. As we saw earlier this semester, the multi-step income statement has a lot more information. We see some other equations here. Sales minus cost of goods sold gives us gross profit. Gross profit minus operating expenses gives us operating income. From the operating income, we add and subtract other revenues, gains, expenses, and losses to get income before taxes. We subtract out income tax expense in order to get net income. Both formats, the single step and the multi-step, report earnings per share on the income statement below net income. Let's look at Apple as an example. Here's Apple's income statement. Again, we have the gross margin, operating income, income before taxes, and finally net income. We can look at Apple's income statement or net income over the past 3 years and see how it decreased between 2015 and 2016 and increased from 2016 to 2017. We start looking at what may have caused this, and so we go up to the subtotals above. We see that provision for income tax expense was relatively constant. Operating income, most of the results are being driven from changes in operating income, and we also see similar patterns in gross margin, so it looks like it's coming from operating activities. Below net income, we see earnings per share information. We're given both basic and diluted earnings per share. The company also chooses to report the number of shares used in calculating earnings per share, and we have that here. Not all companies report this section, the number of shares used in the calculation of earnings per share, on the face of the income statement, and if they don't, then we can find that information in the footnotes. Let's start our notes off by looking at earnings per share information. So basic earnings per share is equal to net income minus preferred dividends declared or paid in that period divided by the weighted average number of common shares outstanding. This is a way for the common stockholders to see what was their piece of the pie for this period. Those earnings belong to the common stockholders. Preferred stockholders have power that's somewhat similar to debt. Preferred stock is considered a mezzanine level of investments. It has priority right below the debt holders but above the common stockholders. And preferred stockholders are typically limited to a certain amount of dividends, unlike the common stockholders who have the final. They take on most risk, but they can also reap the most benefit if the company does well. So remember, this net income is not actually distributed to the common shares. It's just a way of looking at performance for the period scaled by how many shares there are outstanding. Earnings per share basic uses the weighted average number of common shares outstanding as the denominator. This calculation ignores the potential impact of securities that can be converted into common stock, such as options offered in compensation plans and convertible securities, such as debt that is convertible to common stock. EPS diluted, again, is net income. Now this time it's net income as if all of the dilutive securities have been converted into common stock. This may have an impact on net income if it happens. So net income could change slightly from the reported net income. Again, we subtract preferred dividends. But now what's different is the diluted EPS includes all the effects of potentially diluted common shares that were outstanding. So we're going to get a different denominator here, a larger denominator. But remember, the diluted EPS is only as if the dilutive securities have not actually been converted into shares of common stock. There are two additional items that we need to consider before we move on. One is discontinued operations. If the company eliminates or discontinues a component of its business that represents a strategic shift that has a major impact on the company's operations and financial results, it separately reports a gain or loss on continued operations after tax below the income tax expense. A partial income statement would look like this. So the top portion would look exactly like we've seen before. We would have our operating income, our income before income taxes. Let's start with income before tax. We would subtract out income tax expense or provision for income taxes. And now instead of just simply reporting net income, what we would write is a different subtotal, which is income from continuing operations. So this line item is only used if there is discontinued operations. From the income from continuing operations, notice how we've already subtracted out income tax expense, so anything down below that we report must be net of taxes. So therefore, we're going to add or subtract gains or losses from discontinued operations. And again, this is going to be reported net of tax. And then we would have our line item net income. If a company does report discontinued operations, it must report earnings per share, both related to income from continuing operations and from discontinued operations. So what you would have is your earnings per share related to continued operations, continuing operations, the earnings per share related to discontinued operations. So what this is just simply your gain or loss from discontinued operations divided by the weighted average common shares outstanding. And then we're also going to reconcile this down to EPS total. Just simply your net income divided by weighted average shares outstanding. Let's take a look at an example. Target in its most recent 10K. Here we have Target Corp. In its most recent 10K, we see here gross margin, earnings from continued operations, interest expense, earnings from continued operations before taxes, income tax expense, income from continuing operations, and then finally discontinued operations net of tax. See, it wasn't much in the most recent year, and then finally net income. We also see earnings per share rather than simply reporting just basic earnings per share and diluted earnings per share. We have three components to basic earnings per share from continuing operations per share, discontinued operations, gain or losses per share, and then net income per share. Same calculations are done for the diluted earnings per share. All right, so we said we have two additional items to discuss. One was the discontinued operations and the accounting for that. The second is accounting for non-controlling interest. Remember, I talked about this briefly in our very first class of the semester. If a company owns a substantial interest, more than 50% of the shares, in one or more other companies, it will consolidate the financial results of these companies into its own financial statements. The consolidated net income shown on the income statement is then allocated to the controlling company or the parent company and the non-controlling stockholders' percentage of ownership in the subsidiary. For example, let's assume Walmart owns 99.937% interest in a subsidiary. Now this is clearly more than 50%. So it consolidates all of the subsidiary's financial performance. Consolidated net income for the most recent year for Walmart. Consolidated net income was $10,523 million. So $10,523,000,000. So what portion of this is attributable to Walmart? Well, 99,937 is attributable to Walmart. And the remaining portion is going to be attributable to the non-controlling interests. So this will be 10,523 times 0.99937 works out to be 9,862, and the difference here 0.00063. This works out to be 661 million. This is attributable to non-controlling interests. And let's take a look at Walmart's income statement. All right, so we see Walmart's revenues, operating income, lots of interest information. Here's the net interest. This is another other gain or loss. In this case, it's a gain on extinguishment of debt. Income before taxes, income after taxes, or simply net income. So every number that we see up above net income includes all subsidiaries, even the portion that is not fully owned. So then only this final income number is allocated towards the portion that's attributable to the non-controlling interest, and the remaining belongs to Walmart's stockholders. Of course, then we see our net income per share, diluted earnings per share, and again, they give us the weighted average common shares outstanding here for Walmart. All right, next thing that we're going to do is look at Target's most recent income statement. And I have saved that down in Excel. You can find this file in Blackboard, and it's simply called target.xlsx. I've taken their income statement as it was reported, and I scrambled it so that we can, I just think these items are in alphabetical order. And what we want to do is reconstruct the income statement as it's supposed to be. I'm going to begin by making a copy and calling this my income statement unscrambled. And when I'm finished with this sheet, I want it to look exactly like the income statement that was reported, but I'm not going to cheat by beginning there. What I essentially have here is a puzzle. I want to move this data around to try to recreate this income statement. So let me give myself a few extra lines. I have the earnings per share data as it should be. What I do want to do, however, with this earnings per share data is recalculate it based on the information that's given. I'll do that when I get to the end. All right, so what's my top line on the income statement? It is going to be sales. From sales, I want to subtract out the cost of sales, and that will give me my gross margin or gross profit. Next, I want to look for what I think might come below gross margin. Depreciation amortization should be there, and selling general and administrative expenses should also be there. In terms of order, it doesn't matter too much which would come first. Really, we want to put the items that most closely relate to Target's primary operations closer to the sales number and farther from that income statement. I'm going to put selling general administrative expenses first, depreciation next, but it would not be wrong to switch those other two. Next, I'm going to allocate this gain on sale. Could the gain of sale be reported in the other revenues and gains section? It could, only because I know I already looked at the 10K when I scrambled it. I know that they report this in the operating section. So next I'm looking to see if there's anything else that might be included in income from continuing operations. Nope. So then the next subtotal that I have here is income from continuing operations before interest and income taxes, and I can check that by taking my gross margin, subtracting my SG&A, subtracting my depreciation, and sure enough I get 4312. Next thing that is going to be reported is net interest expense. Remember, we're moving from closer to sales and farther from closer to the company's primary operations to what is less focused on the company's primary operations, and interest expenses. A little less focused. That's not what Target is in the business of doing, is creating interest income or incurring interest expense. So then I'm going to have earnings from continued operations before taxes. Taxes always go at the bottom. We say that the companies have the least control over that expense. Put in my provision from income taxes. Now remember that this company, that Target does report discontinued operations. Those are always reported towards the very bottom because it's not expected to affect future earnings. All right, so now where we would typically show net income as the next line, we now have earnings from continuing operations only because the company does report discontinued operations. And then finally net income. And if I want to check any of these subtotals, I can take this, subtract out interest expense. I should get my earnings from continuing operations before taxes. I do, and I can continue checking my numbers and so forth. All right, so the next thing I want to do is make sure I know where these basic earnings per share and diluted earnings per share numbers are coming from. So let's delete this data here and try to recalculate it. Basic earnings per share from continuing operations. Remember we said if the company does report discontinued operations, its earnings per share is not simply going to be net income per share, basic and then diluted. We have to do all three components. Continuing earnings from continuing operations on a per share basis. And we're given the number of shares here for basic. Earnings from discontinued operations on a per share basis. And then finally, the difference between the two, the net, or actually in this case it was a gain, so adding the two together, or taking our net income and dividing it by the basic number of weighted average common shares. And I'm going to copy these over. Before I move on, I'm going to check my numbers, 537, 474, and 535. I see I'm off by a penny here. And a penny here, that's probably just due to rounding. This shows that it's 1 cent, but perhaps if we brought this out, that's most likely just due to rounding. Now, diluted earnings per share, the only thing that's different here, we're going to have the same numerators, income from continuing operations, and now we're going to divide that by our diluted number of shares. This is as if all dilutive securities were actually exercised and turned into common shares. That would dilute the existing shareholders' claim to the company. Next, discontinued operations divided by the diluted weighted average number of common shares outstanding, and so forth. Okay, I'm going to check these numbers, 533, 470, and 531. Excellent. In the next video, I'm going to create a classified balance sheet, including as many accounts as I can think of, and then we'll do a similar construction of Target's balance sheet. After watching the balance sheet video, please practice by reconstructing the balance sheet and income statement for Walmart and for Costco using the Excel files and instructions in Blackboard's Class Materials section.